Good morning, folks. Hope everyone's having a great trading week so far. And of course, happy Taco Tuesday to all those who celebrate this momentous occasion. Pretty interesting morning so far. Got some CPI data in that came in largely in line with expectations. Markets had a positive reaction to start off with and seem to be set to carry that into the trading day. And thank you for joining me for this week's episode of Back to the Futures. We're going to kick it right off. First and foremost, I always like to talk about risk, and really it comes down to one simple concept. Don't risk more than you're willing to lose. At the end of the day, that means really trying to limit your losses to 2% or less of your total portfolio capital. And that has a lot to do with how you size your positions, where you're placing your stops. Ideally, you're sizing your positions based on your stop, and you're figuring out your stop based on the potential volatility. Once you have that calculus dialed in, it gets a lot easier to manage risk. And that's something I like to talk a lot about because I know that traders really do tend to struggle with risk management, especially early on. In fact, that's the leading reason why about 90% of people don't make it as traders. They don't manage their risk and they don't build a system to trade against. So that's one of the things that's the most important element for how I like to look at trading. I like to take a much more systematic approach. I've been doing this for about 20 years now, 21 years trading actually. Now we've got to 2005 to 2026. I'm still getting used to the fact that it's a brand new year and I'm further dating myself. 21 years of trading, 20 years of investing. It's been a wild ride, but the one thing I can tell you with absolute certainty is you've got to be accountable to yourself. If you're not journaling your trades, then how can you be accountable to yourself? What do you have to look back at and review to understand what's working and what isn't working? And folks, while you're watching, if you have any questions about anything I'm talking about, you're always welcome to chime in. Pop them in one of the chat rooms. I'll certainly get to them as soon as I can. Good morning, Tony. Good morning, Lynn. Good morning, everyone out there that's tuning in. And just a quick recap of CPI, we had headline come in at 2.7%. That was within expectations. We had core come in at 2.6%. That was just below expectations. And we had month over month core come in at 0.2%. That was also below expectations. The forecast was for 0.3%. And headline month over month come in at 0.3%, which was within forecast. So seeing some softening in core, that's really what the market's been wanting to see. That apparently helps to boost the case for the Fed to cut, although now we have a political war between Powell and Trump that may not necessarily help with all of those outcomes, all things considered. All that being said, today's calendar pretty light overall. We do have JP Morgan earnings coming in. Earnings really kind of starting off now. You could say we're now in Q4 earnings season. That's Q4 of 2025. Starts off with the big banks. And that means we have some more volatility catalysts to start keeping track of with earnings on deck, really for the next couple of months. We also have some Fed speakers. We've got Muslim at 10 a.m. We've got new home sales at the same time. And we also have a 30-year bond auction later today at 1 p.m. Yesterday we had a 10-year. It went pretty well. We had a stop through, and the bid to cover ratio was reasonable, so wasn't a bad auction. We'll see how we do on the longer end of the yield curve today with the 30-year. Now let's take a look at a few charts. Got about 25 minutes until the market opens, and we've got some interesting charts to take a look at here. First one is the S&P 500. And we finally broke out of that range. You'll probably recall for the last several months, I had a range on this chart. I finally removed those indicators. And part of it's in hopes that we don't revisit that range anytime too soon. But I will say we do have a pretty formidable resistance level overhead. That is this call wall. I've marked it on this blue line. This is SPX 7000. It translates to the S&P 500 futures level for the March contract, 739. That's the delta between the two. And that delta continues to shrink as we approach expiration. But the point is that we do have some formidable resistance overhead. I do think that's an area where we could start to see some consolidation or even a pullback. There's a lot of indicators, both in positioning and sentiment, that are suggesting that the market's getting just a little bit extended near term. So it wouldn't be too surprising we get up to 7,000, maybe even push above it temporarily. But what I would prefer to see to give us a healthier outcome, a longer term uptrend, would be a bit of consolidation or a pullback around that level, just to shake the tree. And if you think about it, the way that folks look at this market, a lot of people tend to get in late on these moves. Those same folks are the most vulnerable to be shaken out. So are the folks that are running higher leverage. So you get a little bit of volatility or even some sideways action. You shake out some of those specs, some of those late longs. And then once the rally resumes, they come in and they're going to be buying in again, helping to push prices higher, right? So shaking the tree out kind of helps to reset the positioning, helps to open up the opportunity for the market to continue to push. And so that's what I'm looking for based on the setup. A hit to the call wall around 7,000 SPX or 739 ES, maybe even getting above that level. But I don't think we necessarily have a big decisive move that breaks above it until we correct some of the sentiment and positioning excesses. And I'm looking at data from JP Morgan, Goldman Sachs, some of the investment surveys from NAAIM, and the other data that we look at in the options market to draw that conclusion. But I think once we clear that out, once we flush out some of that excess, there is still room to move higher. We do also see some of the larger trading desks rolling up their positions to higher strikes on SPX. The 7,100, 7,150, 7,200, all starting to see more positioning rolling into them. So once we do shake the tree out, get some of that positioning kind of flattened out and we have room to run higher, I still think we have room for at least, another couple hundred points to the upside on the S&P. But the big determinant factor will be earnings season. And the narrative is predicated on the idea that we're still going to have plenty of catalysts for the generative AI growth story. So I think that's going to be what a lot of investors are focused on. Are we starting to see some ROI on a lot of this AI CapEx? That will be something that I believe will set the tone for this quarter. And speaking of tech, we've got the NASDAQ on screen. NASDAQ's call wall right there, right where we are. So you can see we were not able to break back above that uptrend line. We're still kind of precarious in terms of the technicals and the NASDAQ from that perspective, but we are above the 21-day exponential moving average. We're above the Ichimoku cloud. So from those two perspectives, we're in an uptrend. But we do have a wall of calls just overhead that could provide some formidable resistance. And it has in the past, as you can see. This is a level the market remembers. Now we're starting from a higher low here, so we have a higher chance to break above this wall of calls. So I think the NASDAQ might be in a position to do a little bit more than the S&P here. Maybe it can catch up. Maybe it can make its own new all-time high. We'll be watching the relative strength of tech today, see if we get a little bit of extra oomph there. We can see, for example, pre-market, a little bit of a bid in AMD and Intel, both of them up about 4% ahead of the open. Semiconductors have been a big area of strength last year and going into this year. So that's another area of the market to watch. In fact, I think SanDisk outperformed the NASDAQ by an insane amount. over the last year. I want to say it's over 100%, but I'll have to go back and look at some of the statistics I've been compiling. But that was a spinoff from Western Digital. It's a pure play on flash storage. A lot of demand for flash storage because of generative AI. It's very storage intensive for these larger models, and then collecting the data, caching, etc. So we're seeing that storage demand really accelerate. And SanDisk, being a pure play on that type of storage, has had a heck of a bid. But so have a lot of the other semiconductors. Micron has had a really good move as well. Google's been a beneficiary of this story, and its TPUs providing an alternative to NVIDIA's GPUs. That's been a big mover as well. The story for a lot of those stocks may not be quite over yet, but it's going to have a lot to do with that AI CapEx story. So for now, watching the NASDAQ as to how it behaves around this wall of calls, I think this is going to be a pretty decisive level for us to watch in today's trading day as well. Moving on to the next chart, one of the favorites for us to talk about over the last several years has been gold. Absolutely incredible performance by the precious metal. There's no doubt that now it has the attention of just about everyone. And this rally started in early 2022. And a big reason for it was when Russia invaded Ukraine, the West started to weaponize the dollar in Western financial systems. And whether you agree with that or not doesn't matter. At the end of the day, if you're in a country that's transacting in dollars and using dollar denominated assets as reserves, that strikes a little bit of anxiety into your financial system, into your central bank and government. And so we've seen the demand for gold from central banks, from governments, and even from investors continue to rise. In fact, there's been a big change of character over the last now almost 4 years. And that is when there's geopolitical tensions, when there's more uncertainty, the dollar used to be a big safe haven in those situations. Not anymore. Now it's gold. Gold has been getting a bid, and the dollar has actually been sold off more often than not when there's an escalation of geopolitical tension. So I think that speaks to gold's role as a true safe haven asset. But the backdrop here is also one that is very bullish for gold and silver over the intermediate to long run. It is one of expansionary monetary policy. We're looking at more cuts. We're looking at the Fed's, quote, not QE, unquote, injecting capital into the short end of the treasury market, about 40 billion a month. We can see that in the expansion of their balance sheet. That is adding liquidity. We can see it in fiscal trends. There's a high level of deficit spending across both the Biden and Trump administrations. It's not partisan. It's essentially just a government that has become such a critical part of economic activity that it simply cannot pull back. And so if you look at the amount of deficit spending as a percentage of GDP over the past two administrations, it's been among the highest ever with unemployment this low, which just again reinforces the point that fiscal excess is another foundational support for gold and silver. And really, at the end of the day, as long as the government has running a big deficit, that's debasing the purchasing power of the currency, in this case, the dollar. So that is structurally bullish for gold as well. Now, I will say we are at the top end of this channel. So as we have in prior occasions, we may pull back a little bit here. We may pull back to the 21-day EMA. That has been support, as has been the bottom of this channel. So I wouldn't be too surprised to see that. It would be healthy to get a little bit of a shakeout. Overall, though, precious metals are not showing signs of the sort of euphoric mania that the price action would suggest. The overall amount of capital allocated, the flows, the positioning and commitments of traders, all of those are still somewhat modest. The only real excess that I see that concerns me right now is the call skew in silver. It's become very lopsided, and so it suggests there's a lot of speculation on higher prices, which, it makes sense. I mean, the trend has been powerful, it's been unforgiving, and it has been just up, up, and away in the price of silver, which we'll move on to that chart now. And I think that's something that has gotten a lot of people really excited. When people get excited these days, they play it with options, but it is a warning sign. And that is to say, On the other side of it, when you have lopsided skew, if something consolidates or worse yet corrects, the negative liquidity effects are amplified because A, time is not on the side of those options. They're losing value. That drops their delta. That means dealers can sell some of the hedges they took on when they were, basically selling calls to clients and hedging that by going long silver. As those calls lose value, they can remove some of those hedges. As those calls, let's say, for example, silver does have a move down, like we've seen during some of these prior episodes of volatility, you can have a bit of a rinse out of that premium as well because those calls are moving further away from the money. So then you have dealers wanting to sell more of that positioning. So it becomes a bit of a feedback loop because then if you're long those calls, you're seeing them go against you, you're exiting some of that. That also means that the corrective events, the time frame for them sort of shortens, right? And we've seen this in the equity markets, we've seen it in others, that the time frame for corrective events has tend to compress a bit over time. So the good news is that when we get another sort of corrective consolidation or downdraft in silver, it probably resolves quickly. But I would say that it's a good time to be a little more cautious. I wouldn't be starting new longs here because we could very easily pull right back to 80 and start to consolidate at the top of the last range with any kind of negative pressure. But long term, I'm very bullish on gold and silver. I'm looking for gold to get to 6,000 this year. I'm looking for silver to get over $100 probably this first half of the year. And then we'll probably see some more consolidation. But ultimately, the backdrop for precious metals is extraordinarily bullish. And the other part of it, we talked about monetary expansion, we talked about fiscal expansion. It's also uncertainty, economic uncertainty, geopolitical uncertainty. Those are really powerful catalysts for precious metals. And then we have industrial usage picking up, and that's shown in the price of copper, platinum, palladium, and yes, our friend silver, which more than half of the usage is industrial. Most of that is from the US and China, and we're seeing that usage in China and the US both pick up. That has to do with silver being the best conductor of electricity on Earth, so it has a whole lot of industrial applications. Let's take a look at Bitcoin, our friend over there in crypto land, which has just really not had a good year overall. And I'm talking about from the beginning of last year to where we are in the present. There are a lot of hopes. There was a lot of talk about, this was going to be the era of crypto. It just has not manifested. Now, the good news is we're not breaking the bottom of this range. The bad news is we're also not breaking the top of this range. We're just sort of stuck in a really big $20,000 trading channel in the price of Bitcoin. Now we are starting to push above the 21-day EMA. We retested it, kept above it. That's a good sign if you're bullish near term. But we are stuck in the Ichimoku cloud the same way we're stuck in this trading range. What does it mean to be stuck in the Ichimoku cloud? It means you're trendless. So that's something to take into consideration. Not seeing any powerful buy signals in crypto yet, but I am overall a little bit more structurally constructive on it because with all the things we talked about that are helpful for precious metals, some of those should help crypto as well. The abundance of liquidity coming into the financial system from the Fed's program to buy short-term treasury debt is pretty much what put a bottom in Bitcoin. And I think that if we watch bank reserves and aggregates of global liquidity, even looking at things like the reverse repo auctions and otherwise, we can get an idea of when that liquidity is starting to build. And as it does, I believe just like Bitcoin sort of followed it on the way down as liquidity was becoming more scarce, as it becomes more abundant, I think Bitcoin will follow it back up. And that's because I look at Bitcoin and other crypto as a relief valve for excess speculative liquidity. I really think that's the core role it plays in the global financial system, for better or worse. And that means when there's extra liquidity around, it acts like a sponge and pulls some of it in. Now let's take a look at these weekly pivots. We've recently added gold and silver to them. I'm also going to post these on Twitter or X, whatever we're calling it these days. But overall, we can see that we're in a pretty constructive place We're above our pivot for S&P, we're above our pivot for NASDAQ, we're above our pivot for gold, and we're above our pivot for silver. So all of them are bullish in terms of the swing time frame going into this week. And these are levels that I share with Trader Aid members before the trading week starts. But I like to share them on this stream so you all can have a sense as to what we're doing, some of the signals we create. This is based off of automated analysis of volume profile, price action, options, and other areas in the market that can help to provide levels that can basically give us a marker in the sand as to whether or not buyers or sellers have an edge. And folks, if you have any questions about anything I've talked about, let me know. We've got about just 9 minutes until the market open. All right, those pivots are out there. You're welcome to capture screenshots for yourself as well from the stream. But overall, coming into the trading day with the potential to break above the call wall on the NASDAQ and at least retest the call wall on the S&P 500, at least do some initial testing on that SPX 7000 or ES 7039 level. That, I think, is going to be our line in the sand for today for the S&P. If we can break above there, it is likely we get some continuation. But again, I think that the market is going to want to consolidate sooner than later based on the excesses in sentiment and positioning. And I don't mean anything too crazy either. When I say the market may want to correct, I'm talking about the excesses in positioning and sentiment, not necessarily a straight up 10% drawdown. Corrections can also happen through time, the same way they can happen in price. That is to say, you could go sideways for a bit and shake out loose hands because their options are moving against them. Good morning, Low Key. Low Key asks, in your opinion, what's your thoughts on Trump and Jerome drama? Why is Trump so eager to have yields rise? So I think that's a good question. It really has to do with Trump wanting to put pressure on the central bank to cut rates. A lot of this has to do with that, and it really has been. He's been vocal about this for a year now, that he thinks Powell is not doing a good job, that he believes that interest rates have to come down meaningfully, and he has been kind of trying to find different ways to pressure him into that outcome. And Powell's now back into cutting rates as it is. So I'm not really so sure as to why additional pressure is necessary here. But it's interesting because it's already starting to backfire. You're seeing Republican senators saying, well, this actually may hold us up from being able to confirm the next Fed chair. And there is a little bit of a pushback on all this because it seems a little arbitrary to go after, Powell for the renovations. I mean, if you're going to go after the Fed for something, you could go after them for the insider trading stuff. You could go after them for not managing inflation well. You could go after them for not managing the Silicon Valley bank crisis well, where they knew well in advance what was happening and they didn't ring fence it or, clamp down on the bank. I mean, there's so many things. There are so many supervisory regulatory issues you go after them over. Going after them over to the renovation seems like a nothing burger. And if you look at a lot of the prosecutions that have happened so far under this administration, they've also been nothing burgers. So I don't think much will come out of it. But I do think the bigger risk, so to speak, is when we see the new Fed chair named. If they have a decent chance of being confirmed and they start talking about what their policy is and how that differs from Powell, I think Powell will become less and less relevant. And that Fed chair will have greater control over how the markets react to the Fed even before they're running the Fed. Because Powell is no longer going to be chair of the Fed as of May, but he's still on the board of governors unless he steps down until 2028. So just some things to think about. Welcome to Dvorak. And Devil's Metal says, I missed most of this gem. What was the main synopsis for today? Metals up, dollars cooked. I mean, you're welcome to go back and rewind. I think it will let you do that. But basically, the main synopsis for the metals is that structurally they're still bullish, but silver is getting a little bit extreme on the call side driven speculation. So it wouldn't be terrible to see it consolidate or pull back a bit. And gold is reaching the top of its channel. So it also may have a little bit more risk in terms of where it is, or it could just break out and start to go parabolic and follow silver. But for both of them, having traded these things for quite a while, what I'd really like to see is some consolidation or a correction, because that helps to build the foundation for a longer, healthier uptrend. You need to have that market structure of consolidation in place so you have areas of support to retreat to when price goes the wrong way. And it will. I mean, this is just inevitable. Markets don't go straight up in anything, but when they do, they tend to have crashes. That's to say, when parabolic moves happen, and this is why markets don't go straight up, because then they go straight down, right? So we don't want to see that outcome ideally, especially in silver, which has had a pretty parabolic move. It would be really ideal for it to get to a point and just sort of chop sideways, bore everyone to death, or even pull back 10%, 15%, shake the tree a bit, and then continue its journey. I'm not saying that's what has to happen, but if that is what happens, it's way more bullish for long-term price outcomes. Good morning, Stephen. Good morning, everyone. Should be a fun day. Market's opening in just about 2 minutes here. I do have some deals to share with you all on screen. You're welcome to check them out. You can get up to 20% off trader aid plans. That's on our Discord with the code Mayhem20. You can also get up to 40% off of Bookmap using this link, traderaid.com/bookmap, and scroll down to the special offers. And we are going to dive right into Bookmap here. As we get ready for the market open in less than 2 minutes, we've got the S&P 500 on screen. We'll zoom out just a little bit to capture the overnight session, mostly consolidation until this morning. Then we had that violent move upwards. And again, CPI coming in largely within expectations, some signs of cooling within core, which is good. We do want to see cooling within core. Although I will also say the veracity and integrity of the CPI data set has always been questionable. And it's a bit worse after the most recent government shutdown, because the survey data is not really being collected and aggregated efficiently or effectively. There's a lot of inferences being made. There's a lot of cuts that happened at BLS that made their already questionable data a little bit more questionable. Personally, I would be much more in favor of gathering prices with data rather than surveys. Because if you don't know, only about 40 to 45% of survey respondents for CPI even respond. It's all driven by people and them looking at their receipts and then filling out surveys. It's 2026. I think we have the technology to gather regional price data in real time without surveys and have much more accurate, much more near time data that's current to the minute when it's printed. That would be way more helpful for everyone. Maybe eventually we'll get there, but that's where we are. Market's happy because of some cooling trends in core this morning. Some of that pulling back, though, as we get ready for the market open in just about 5 seconds. Got a bit of a buy side imbalance on the market on open imbalance. So Juan asking if I can give my take on gold. I'm happy to go back over it. I think gold is still structurally sound, but it is at the top of its trading channel. So we may see a little bit of resistance here. I think overall gold to, 6,000 this year is very reasonable. 5,000 this quarter is very reasonable. And gold is bullish because you've got expansion of fiscal policy, you've got monetary easing, you've got geopolitical and economic uncertainty. It's like the four horsemen that drive gold higher. So everything overall tells me gold has room to run, and the miners may actually begin to more meaningfully outperform gold this year. They really started last year showing that relative strength in a gold bull market. That's exactly what you want to see. You want to see silver and the gold miners outperform gold price. That's the key. Those are the two kind of checks that you can look at. And then of course when you have those macro catalysts, and folks like to say macro doesn't matter, I'd say macro matters a whole lot, and especially when you look at these long-term macro trends, it's one of the big drivers for gold's price discovery lately. So markets are open. Let's zoom in a little bit more on this price action. We're just above the point of control here. World Bank just upgraded Chinese growth prospects. That's interesting to see. So the former forecast was 4%. Now they're upgrading that forecast to 4.4%. And we are seeing a bid coming back in. These opens are always a bit volatile. The order book so far balanced 15,000 on offer, 16,000 on bid here. And finding some support once again at this point of control. This has been a level where we have been finding support from the open. We zoom out a bit. You can see that's been a somewhat important level even prior to the open as well. So we're going to be watching that as our line in the sand for now. And just overhead, we do know we've got this call wall. This is the area we're talking about pre-market as some upside resistance. So we'll zoom back in just to really zoom in a little bit more on the opening price action. And the opening heat map is pretty bullish. You've got AMD up 6.28%. We talked about them pre-market. They were up about 4%. Then Intel up 3.5%. Google up 1.3%. Got a decent bid in some of these energy stocks. Visa and MasterCard are down, presumably part of that because of some of the pressure that Trump wants to put on the credit card industry, although they make money off transaction fees and not so much interest rates. Got a decent bid in the industrials too. Boeing up 2.1%, Raytheon up 1.5%, GE Vernova up 2.5%, Caterpillar up 1.85%. There's a lot of opportunities outside of just tech, and I think this will be a year where we see those opportunities continue to play out, where there is an expansion in the participation of this market. And we're getting back to the top of this morning's regular trading hours range. You can see that red line here, the highest price level. I am working on an opening range indicator for Bookmap that I'll be giving away. One for Bookmap and one for Motive Wave. I'll be giving those indicators away for free once I have them ready. But just a heads up, that'll be a fun little indicator. And you'll be able to code in what opening range you want to monitor, anywhere from 30 seconds all the way to an hour. I tend to look at the 20-minute opening range myself. This will be the year of building a lot of new trading tools. I'm pretty excited about that. And we are starting to make new regular trading hours highs here. Let's take a look around the market. Let's look at the NASDAQ as well. I like to call the NASDAQ a high beta brethren of the S&P. Is certainly living up to that reputation this morning. Starting to see a little bit more get up and go in the NASDAQ here as it also pushes to a new regular trading hours high today. And we can see that it is pushing above its call wall. We talked about that a little bit pre-market, that we'd be looking for the NASDAQ to try to make that push above its own call wall since it was just right overhead there. And order book on the NASDAQ also balanced 3.3 thousand on both sides. I say that and it changes slightly, but pretty much right on balance. And gold trying to get its footing this morning, up about 0.2% so far. Having a little bit of a struggle at the point of control. Silver looking a lot better this morning. Let's take a look at silver. Silver right now up just shy of 4%. And if you haven't traded silver, you've really got to appreciate that this is an extremely illiquid trading vehicle. The order book is tilted towards the bid, and that makes sense given the way the price action is playing out. It's about 3 to 1, 3.7 thousand on stacked bids versus 1.3 thousand on stacked offers. You can see that on the chart here. Got some bullish call sweeps going into the FXI China ETF. About 171,000 in premium paid for the 45 strike expiring June 30th. There's definitely been some bullish price action in a number of the Chinese stocks and indices. Some major technical breakouts happening over there. So worth paying attention to, even if you don't want to own the country. There still could be some trade setups and some sympathy plays even here over in the US to consider. Let's move back to the S&P 500 on screen. We're back to the top of the trading range, making a decent push to where yesterday's second most active call strike was. We're going to zoom out both in terms of time and price range here. The way this thing is chopping this range, you might get that fill. Waiting for that 20-minute opening range to form to really get a sense as to how dynamic today's trading day will be. I do like to look at the 20-minute opening range as part of my process. So far, it's pretty narrow, about 8 handles or 8 points on the S&P 500 March futures contract. And we should start seeing some of the options flow hitting the visualizer for today's flow pretty soon. We've got yesterday's flow on screen. One thing that's pretty impressive is just the sheer amount of call buying that's going on in this market. 359,000 calls in just the top 2 0 DTE strikes. Oh boy, nasty pull here. So Trump posting on Truth Social, Iranian patriots keep protesting, take your institutions, save the names of the killers and abusers. They will pay a big price. I have canceled all meetings with Iranian officials until the senseless killing of protesters stops. Help is on the way. And then he types in MIGA, M-I-G-A, I guess, make Iran great again. So that caused a little bit of a pull. That geopolitical volatility. How did gold like that, by the way? Gold loved that headline. This goes to exactly what we were talking about earlier, that precious metals love geopolitical uncertainty. When the president of the United States posts that type of rhetoric, it certainly creates more geopolitical uncertainty, and the bid in gold absolutely surging here as a result. You can see the order book tilting too to the stack bids, 4.5 thousand on bid with a delta of 2,000 versus the offers. Sorry about that, folks. I guess that news was a little too much for Discord. If you're on Discord, there's a little bit of a blip there. But we're back. Gold continuing to surge here. Let's take a look at its crazy cousin silver. Silver also getting a strong bid. Crude oil pushing here as well. So we're seeing that geopolitical uncertainty bid. Let's see what's happening in Bitcoin. Bitcoin hasn't liked the geopolitical uncertainty bid the way it used to, and today it's got a little bit of a bid into this headline, but it's starting to fade already, while gold, silver, oil continuing to build here. Gold just absolutely smashing higher. S&P rolling over. We're going to go back to that chart in a second, but the US market's not liking this escalation, at least near term. Eventually it'll fade into the rear view mirror and will continue to climb the wall of worry. But for now, making new session lows. Can see VWAP down here, this white horizontal line just around 7,775. And markets continuing to roll over here. We're actually about to take out all of the post CPI gains. So we're just going to zoom out. And you can see that happening right now, right here on chart. And this is with sellers starting to actually give it a solid push. At these lows, however, it is worth noting, you are starting to see that larger trading desk bid come back in. There was a 2,500 iceberg purchase there and 311 stops triggered on the sell side. So those are prior buyers stopped out to the sell side. So you might say we're getting a little bit more exhaustive down here. We did see a buyer absorption alert print as well. And new home sales coming up in 10 minutes with a forecast of 715,000 versus a prior reading of 800,000. Let's take a look at the NASDAQ here. Also seeing some violence off of its highs. It did get the iceberg sell just like ES, but it has not yet seen the iceberg buyback. We're also starting to see some of this flow coming through. Let's take a look and see where some of that options flow is hitting the tape for SPX. So a lot of calls coming in for the call wall, that SPX 7000, ES 7039 level, about 5,000 calls targeting that level. That is the most active strike on the chain right now for the 0 DTEs. But obviously, this headline changes the mix just a little bit. Gold starting to cap out on its move higher, at least consolidating, but looking a little bit heavy. We'll zoom out, just take a look at the order book a little more closely here. Definitely more demand for gold. You can see these offers stacking just above, so there is that. But I think that this reaction function was largely driven by algos rather than traders. I don't think a lot of traders were instantly selling the bid for gold, seeing that headline cross. So we may see some of that pullback. Let's see what silver's saying. Similar look, looking a little heavy after that big move higher. I mean, it makes sense. You have the natural language processing algos. They're bidding based off of just reading the headline, assuming it's an imminent escalation. The reality is it's just rhetoric. So maybe it doesn't deserve quite the premium it was given. And similarly, maybe we'll see some of this move to the downside undone in equities, just like some of the move in the upside is being undone in precious metals. And we are seeing that. We're seeing just a little bit of that downside being undone. Cooler heads prevail. I mean, look, on the one hand, it's not great to see that type of rhetoric. On the other hand, does it have a near term impact on earnings, the economy, or anything else the market's pricing in? Not really. You'll note that geopolitical tensions in the market, in the stock market, tend to be discounted more and more as time goes on and things don't worsen. This happened with Russia, Ukraine. It happened with Israel, Iran. It's happened kind of time and time again. In fact, there's some great charts that you can look back to for even more major conflicts and how eventually they're just a blip in the rearview mirror. And the depth of the drop has a lot to do with the intensity of the conflict. In this case, there hasn't been one. So we'll see how it shakes out. But typically the near term reaction function is a little bit extended. Now we do have a opening range to look at here. It's not very big given some of the excitement we have with CPI and with saber rattling against Iran, you would think maybe we'd have a little bit more of a dynamic opening range. It's about 10.5 handles. Now, for me, my rule of thumb is I really like to see 12 or more handles on the S&P. And as it rises in price, I have to adjust commensurately. Ideally, I really like 15 or more. So, not really seeing a great setup yet. But if I did want to trade this thing, I'd be leaning more on the bullish side, and I'd be looking for the point of control to justify that. So I'd want to see a break above this point of control, some acceptance built above, and then we'd be targeting that most active call strike, which takes us to 70.39. So that's the trade setup I have. It's not a super high conviction trade because we have a narrow range and we have some, just not a lot of conviction. Also, I will add, this is options expiration week. So if you like indicators and analysis not working as reliably, then this is the week for you because things tend to be a little bit more iffy on OPEX weeks. So those are two of the things that pull my conviction back just a little bit, but overall leaning more towards upside, especially after that nice flush out we just had. And we're looking at 70.16.25 as the line in the sand, initiating longs above there, targeting the most active call strike, which is currently looking for 70.39, which is SPX 7000. That's the wall of calls we talked about pre-market. And you'll note I'm not going to force trades. That I won't do that for the sake of entertaining people, but more importantly, I won't do that for a very simple reason. It encourages bad behavior. It encourages people to do things that can get you hurt. And I'd really prefer that you all learn how to trade properly, which means don't be a dopamine-driven trader. Be a serotonin-driven trader. Don't do this to gamble. Don't do it to feel something. Don't do it because you need to have skin in the game. Do it because you want to build consistency. Journal your trades. Be accountable to yourself. Review that journal every week. Look at what's working and what's not. Figure out what strategies allow you to become more consistent. Remember, we're all wired differently. Not everyone's wired to be a day trader, just like not everyone's wired to be a swing trader. So figure out what time frame, what asset types or asset personalities, because they do have unique personalities. I mean, look at how different gold is versus the NASDAQ, versus silver, versus the S&P, versus Bitcoin. They're all so different. Even individual stocks can be quite different from one another, depending on the participants, depending on their mindset, depending on the algos. So figure out what works for you. Lean into that. Build an edge. At the end of the day, it's not just about trading for the sake of trading. It's about running a business. What you're buying, you're taking on into your business's inventory. And when you're selling it, you're hoping to capture a positive spread. That's to say that it's appreciated in value. Just like when you're selling something to go short, you're borrowing against it. You still want to buy it back lower so you can capture a positive spread. Have a strategy that defines your risk to reward before you get in the trade. Start journaling that trade's entry and thesis before you even pull the trigger. You'll notice sometimes you don't even take a trade because once you start journaling it, you're like, wait, I don't think this is really a great setup after all, because you're thinking it through more. Then your mind starts to get into this process of thinking things through more. The less you lean into your gut and your emotions, the less you're discretionary about these decisions, the more likely it is that you can build consistency and start to find success. Be patient. Pace yourself. Don't worry about how others are doing. Focus on your journey. That's the only thing that matters. No one's going to be there for you like you will, but you can't do a good job for yourself if you don't understand the mechanics of what you're doing, how the markets work, the reaction functions to different events. You've got to dial that in, which means start with small size, get your process down before the amount of money moving back and forth rewires your emotions so that you can try to take emotions out. And the more systematic you are in your approach, the more likely it is that emotions won't interfere with your execution or your risk management. And the last thing I'll say as we wrap up, always have a stop. So again, you guys know what the setup is. Not really looking for uh, much of a trading setup today here other than longs above 7016.25. Right now, the market has other plans. We are starting to see some of the put flow intensify as well. So we've got to respect the market in front of us. And for now, I don't have any solid trade setups that I see other than the one I talked about where we break above the point of control and perhaps get to that hot call. But if we're not going to break above the point of control, there's no reason to force a trade, especially one that could be lower probability, which means essentially we're gambling. So, folks, I want to thank you for tuning into this week's episode of Back to the Futures with me, Markets and Mayhem. You can learn more about my work at TraderAid.com and get up to 40% off Bookmap visiting TraderAid.com/Bookmap. I'll catch you next week, same time, same place.